Hello, everybody. Kirk Spano here, and it is Monday, February 26th, 2024. And today we are going to be talking a little bit about the market environment and our punch card dividend stocks, as well as a reiteration to look for covered calls to sell. So first off, when we talk about the market, and we talked about this on Saturday in the macro dashes, we want to specifically look for periods where we're in an uptrend, but then the indicators, and RSI is one of the easy things to look at. This is a different type of breadth indicator, will show divergences. So when the technical indicators start to work against price, it means that price is on its last breath or last leg in the particular direction that it's going. Right now, we're starting to see breadth, and this is a particular breadth indicator, start to taper off after expanding, and it is not confirming the rally that we got in there. So what we're expecting is at some point, because it did shoot back up for a minute, it turns back over. And when it turns back over, that means we'll probably get a correction. So this chart is a couple of weeks old, and we've seen a little bit of rally. And then today we're starting to see it flip around again. We are starting to see divergences in various technical indicators. That is generally cause for concern of some sort of correction coming. We talked about on Saturday that the correction coming is probably in that 5 to 10% range and not much worse. If we don't get any correction at all, I'd be surprised and really wouldn't probably know what to do about it other than sell a few things. So if we keep getting rally in spite of the low volume and the lack of real conviction to the upside on the indicators and the technical analysis, maybe it is different this time. But as we know, usually it's not. One of the things to keep in mind is that in the environment that we're in, we usually do see small caps start to lead. And I would expect that as soon as the Fed starts to be more nice and stops kicking the can down the road on rate cuts and reducing the quantitative tightening, then you're going to see the typical type of rally that you normally do with small caps. Tom Lee is talking about it. Other firms are talking about it, and they're starting to put their money where their mouth is. I would expect more rotation out of the mega caps, and you don't have to see a lot of money move and get that shifted into the small caps and some micro caps. The micro caps that are going onto the Russell 2000, that's a great trade that hedge funds make every year. So companies that are 150 million plus, but not yet on the Russell 2000, are the ones where you're going to see a lot of action in the next 3 to 4 months. The Russell isn't like the S&P where it is kind of constantly updating its index. The Russell does it once a year over a 3-month period. So in April, they'll take their initial readings, and then they'll update in May, and then in June. So by the end of June, the Russell 2000 is set up for the next year, more or less. The target market cap for the Russell 2000 new inclusions this year looks to be 180 million-ish, maybe 190 million on the high side, but somewhere in the 180 to 190 million range. So companies that are close are probably going to rally into that. Companies that are already over that level and haven't yet been included, they'll probably get included first. So they'll rally. So really about 150 million, which is right where Metis is at, up to a little over 200 million, and any other companies that have surged past. I've been looking for them. There's a new one for the growth stock list tomorrow. That's really where you want to be focused, is because when the setups that we're getting now occur, generally you have pretty big returns over the next 12 months. I mean, the exception here is 1987, but look at the types of returns that you get. So we don't know. The setup really started to make itself clear in December of 2023. We'll see what these numbers end up being. However, usually they're very, very good. Tom Lee has talked about a 50-60% year this year in small caps. It's hard to know what the index will look like, but I think there will be a lot of small cap stocks that do perform in that 50, 60 to 100% range. IWM, it covers 2,000 stocks. It'd be very hard for the whole index to go up 50, 60%. However, picking out stocks inside that index, which is an inefficient index, right? Because there's 2,000 companies, we are probably likely to see, any number of stocks double or triple by early next year. So I think that is the key place to look. I don't expect 12 years of small cap outperformance like Tom Lee does. The environment today is much different than 2000 and the early 2000s. We have 50% of people indexing to SPY. Half of the money that goes in the stock market just goes into the S&P 500 index funds. So it's a much different environment now than it was 20 some years ago, where people were really spreading it around in open-ended mutual funds. It's just not the case anymore. So I do expect outperformance in the small caps over a few years, 1 or 2 years for sure. But I don't see them outperforming, for a decade. I just don't think that that's realistic. There are huge financial advantages that the giant companies have. They really truly don't get regulated very much. So when they distort a market by buying a competitor or just stonewalling a supplier, they carry so much power that it's difficult to try to, control the mega caps and the large cap companies. They're just too powerful. So until we really crack down in antitrust, which the Biden administration has done a little bit of, I would expect the large caps, given that half the people index to them, to not be the leaders. They shouldn't be, because that's not where the most growth is. But they do have the bigger moats. They do have the financial firepower, and they're going to exercise that power. So I think that it's important that we understand that while we have periods of a couple of years or a few years where small caps can outperform, really coming off of a trough, once they reach parity on the valuations with large caps, you should expect the large caps to then accelerate away and for the small caps to fall back. So you're looking for a 2, 3, 4 year rally on small caps, with the big money coming on the front end of that, probably in the second year when the FOMO kicks in. So you really want to be positioning the small caps right now. I think that this is pretty clear evidence that what's coming is probably pretty good, unless we just get, 1987 is when the Black Monday, right? Black Monday, Black Friday, Tuesday, Wednesday, Thursday, whatever. When the market fell off the cliff in 1987 for a few months. All right. One of the places I'm looking for money is in energy. And it's both in the energy transition, but also in traditional shale and other energy companies. So I've had Hard Energy for years. I go through their articles and their research, and I look for companies that might get bought. Permian Resources is definitely on that list. I think Katera, which we added a couple months ago, is on that list. And I think it's pretty clear that Occidental, even though they're not a big dividend payer, it really is one of the best stocks out there to own in the energy patch. They have the patron of Berkshire Hathaway with permission to buy up to 50% of the shares, and that should probably happen by next year, I would think. They just keep buying shares, and they have the warrants. I know Buffett talks about not buying the whole company, but I think there's a very good chance that they get to half pretty quickly, and they might buy 80%. At 80%, they can consolidate the results, the financial results from Occidental onto their own balance sheet, which means they can capture a lot of those tax credits that Occidental is going to get, and that is kicking in next year. So I think by next year, you see Occidental up quite a bit on purchasing by Berkshire Hathaway. So I think this might be, over the next month or two, the last chance to really build out your Occidental position. And, for something with so little downside, to have the ability to make 50 or maybe 100% in the next year or two, I think it's kind of a no-brainer. So if you're not buying Occidental, I don't know what else I could have said over the last couple of years to get you to buy it. All right, so punch card dividend stocks. This is why this particular meeting will be behind the $1.99 per month paywall on YouTube, is I don't want to give all these companies away. So obviously we look within the big secular trends to find our winners, and that is, the heart of how I invest. Then we look for government support, then we look for the fundamentals, and then the technical analysis. So here's my punch card, 30 up to 30 stocks I can own. And, I know that Buffett said 20, but I need a little bit more margin of safety than that because I'm not as smart as him. So broke it into two different lists, dividend growth stocks and then high yield dividend stocks. And the dividend growth stocks, I was really looking for a dividend growth rate that was sustainably over 7%. Some of these companies, they pull back for a year and then they reaccelerate. I gave Innovative Industrial some credit for the rapid growth up until last year, but I think that these are my favorite dividend growth stocks right now. There's only 8 of them: Newmont Mining, Innovative Industrial, Comcast, American Tower, Stake Industrial, Essential Properties Realty Trust, which is a triple net, and then Permian Resources and Katera. They all pay dividends. They all have good dividend growth rates, and the businesses that they are in are pretty impressive. Now, why Newmont Mining? So we originally bought Newmont Mining several years ago, wrote it up, and then sold it. And now it's beat down to a spot where I think it's probably a buy. We bought it way back in here, sold it in the 30s. So we didn't write it all the way up, but probably I think most you made 50% or maybe even doubled your money on it. It spiked out here towards 80 and then went on a big correction. Now these wedges and are the general pattern that it's exhibiting. The yellow line though is the fair value gap, and this is where the institutional interest really is drawing it to. So each line is kind of part of the fair value gaps, and they act like magnets. So we would expect that first the stock to rally up to about 40, and then looks like about 49, then looks like about 59, and about 70. Will it get all the way up into this area? We'd have to have a good market for that to happen. Right now, it looks like it's pointing towards 60-ish, and I think that getting into Newmont Mining right now, I'm selling puts. I think that that's how I'm going to play this: is sell puts, let them get assigned to me, and if they don't get assigned to me, then I'll just buy as it starts to go up. But their business, they've really rationalized the expenses, and for at least a little while their mines are still viable, they're kind of in a period where the capex isn't going to crush them. As you can see, money flow index falling off a cliff, shaken money flow falling off. The relative strength index fell off, and now it's leveled. So you can see how the relative strength index is leveled. This is a pretty good setup. I haven't seen many setups on mining stocks that I really liked, but I think Newmont is probably the best company out there. They are part of the S&P 500, so that's a huge advantage over Barrick. And this is the only gold mining stock that I will own. This is my proxy for that whole sector, and I think that we probably see, a 50 to 100% gain over the next year or two as the price of gold goes up when the Fed finally does loosen up just a little bit. Innovative Industrial, we've been waiting for Congress to act on not legalization of marijuana, just normalization on the financials. So once all of these marijuana companies and cannabis companies can use the banking system just like everybody else, that frees up a lot of capital for them. Now, I think that the supply-demand imbalances that we saw during the cannabis crash, those are all taken care of. And really, there's not much downside left on the cannabis stocks. We're really just waiting for the catalyst to the upside. In the meantime, Innovative is paying about around an 8% dividend. And I think that you want to use the volatility here to get involved if you don't have a moral problem with this particular type of company. Comcast. It is clear to me that Comcast is going to be a winner in the whole consolidation in the streaming space. They've been rumored to be a buyer of Warner Brothers Discovery. Warner Brothers Discovery just keeps getting clobbered because nobody wants to look forward 2 or 3 or 4 years. That's good for Comcast as a potential suitor if Zaslav doesn't make it difficult. And I think that he'd be willing to cut a deal because he's just about the money. He can be bought off. I think you see Comcast end up with Warner Brothers Discovery, and that is very good for the Universal Studios parks. So I think that that is probably a play here. They could go after Paramount, but then they'd have to spin off CBS News. So we'll have to see which company Comcast ends up with. I think it's very, very clear that that's a likelihood. It's by no means guaranteed, but there has to be consolidation. There just can't be lateral moves. That's why I don't think and I love Byron Allen. Byron Allen is making a play at Paramount, and I like Byron Allen a lot. The problem is that's not really consolidation. That's just a takeover. You need a few of the big companies in streaming and studios to merge. They need to merge, and they need to cut the fat, and they need to press down the prices on the Actors Guild. They need to pay the superstars a little bit less money. They need to find more new stars that are cheaper. There's a lot of things that they can do. They can get rid of a lot of the TV stations that they own at Paramount in particular. So we can see what's coming. The problem is people aren't patient. A 2 or 3 year decline in stock price, everybody runs for the hills. I do think that this was the capitulation on Comcast. We talked about it late last year, and it has done pretty well since then. It's on a little bit of a pullback now. This is huge institutional support in the fair value gap. And I can update this chart actually, because this is before I went to the new format that showed things just a little bit better. I like the lines because then you know where the magnets are. So I'll add those here. But a price, anywhere below 40, pretty easy buy to get into Comcast. And then once they complete their merger, and remember, they got that big check from Disney, just burning a hole in their pocket so they can go out and buy somebody. And Paramount and Warner Brothers, it's free money. So I think that they're going to end up with one of them. We'll see. Paramount gives them Star Trek. Then they can put that at Universal Studios. Warner Brothers gives them DC. So either way, whichever one they buy, which again, I think is over 50% likely, they end up with something really cool they could put at Universal theme parks. In the meantime, you collect a big fat dividend. American Tower, people talk about Crown Castle, but I like American Tower for 2 reasons. Above Crown Castle, they have the emerging markets exposure where all the growth is. I don't want to own Crown Castle and just have a very mature American cell phone tower network. Who cares? There's no growth there. American Tower gives you the best of both worlds. It gives you United States stability, and then it gives you access to the emerging markets. And they own part of AST Space Mobile. And we are seeing that is just about to go live as they get ready to launch their satellites. So I like American Tower. If it gets into the 160s, it seems to be a pretty good buy, and then rally back up into the middle or upper 200s. I don't know when we break these 2021 peaks. I don't know that it'll be the next rally. I think it might be 2 rallies out, 2 bull markets out. But the next bull market should get us there. Then we'll come off again, and then finally, maybe 6, 7, 8 years out, we finally break the 2021 highs. I don't think we're going to break the 2021 highs next time. I think this bull market that's coming over the next year or 2 gets us close. It's a test, and I think it fails. We'll see. Essential Properties Trust pays a real nice dividend, and if you take a look at their portfolio, it's just hard to not like it. They also are buyable pretty nearby. So if you can get them, really you could buy them now, and I don't think you have to worry about it. I think this particular stock breaks out the new highs. They're just very undervalued. This is a stock that the dividend chasers haven't found yet, and that's because they just raised their dividend and it's not showing up on the back testing, and it's going higher. So this is one that I think people are going to get caught by next quarter. Permian Resources and Katera we've talked about. I think that both of these are very buyable nearby. These guys have broken out. I think they're over 15 right now. So Permian Resources is over 15 right now. Would you like to buy it down here at about 12.50? Yeah, you would. So I think you can sell cash secured puts, just keep selling cash secured puts. But I have almost a full position in Permian Resources now. And my intention is to make it a full position imminently. I do think that we're going to get that little stock market pullback soon. And that's when I expect to get the full positions on some of these. Katera, I haven't added yet, but it's another one that is just projecting out really well. I mean, this stock, if they get bought out, I think that this area up here is probably the one. You got a couple different lines. So this is called confluence when different technical indicators point to the same spot. So I think that a price somewhere in the 50s is what the market is expecting. So that means you get a big ramp up here and it probably gets bought out up there, would be my guess. So your high dividend stocks, the ones with the big fat yields, well, some of them aren't what you'd expect. Pfizer, Ford, they're paying really big dividends right now, and they have huge growth potential for the companies. So I like both of these, Pfizer and Ford. They're basically both buys right now. Kinder Morgan, if it does get down to about 15, 16, they just keep chugging along. I need them under 16 because they get there sometimes. It hasn't been a while though. Look, if you take a look at the 1-year chart, they've been holding 16. So if you can sell cash secured puts with a strike at 16, collect some premium, go ahead and do it. But you really don't want to cross over that dividend yield X date because it's a big fat dividend yield of 6.5%. Now, here's the thing. They've been buying back shares. Like I told you 2-3 years ago that they would. They bought back over 1 million shares last year. So that's good. Williams, if you wanted to pair Williams, Kinder Morgan, and Enterprise Product, you could. It took me a long time to come around on EPD, but they have really done a good job on their energy transition plans. So, I don't look at them as a juggernaut, and I don't think that their balance sheet is pristine as people think. However, if you wanted a basket of pipeline companies, you could go Kinder Morgan, Williams, Enterprise Products. I'm not doing it. I'm just going to get back into Kinder Morgan at some point because I know the story there with Richard Kinder, and I think it's powerful. I think that at some point, Kinder Morgan gets taken over and it goes for a big premium. I don't know if it revolves around him capturing a low capital gains rate, which means he probably sells it by next year, or if he's waiting for estate planning reasons to sell it after he dies. So we'll see, but he keeps buying shares. I think Kinder Morgan is a hair better than Williams Enterprise Product Partners. But if you wanted a basket, these would be the 3 to own. I went through ONIAC and Energy Transfer, and I looked at 20 different pipeline companies. These are the 3 horses. These are really the 3 horses. Now, one of my favorite stocks at this point is Park Hotels. I am starting to add this to all sorts of portfolios. Park Hotels has just an amazing portfolio of hotels. And my thesis on Airbnb, which is I think that it keeps running into headwinds. I think that Airbnb's growth is done. And in fact, I think it starts to contract in coming years. And that's really good for the hotel companies. There are other hotel companies that are pretty good, but this one's a smaller cap stock. It pays out a gigantic dividend. It's like 10% or 12% or something. Right? Look at Park Hotels. I think actually the growth in the company, I think that this pattern, a jump up and then grind, they're likely to see one of those curves up. I think you're gonna do really well in Park Hotels. There's fabulous hotels, and I think that they're also ripe for a merger. There's a couple other companies out there they might merge with. So I really like these guys. I've taken a look at their balance sheet. I've taken a look at their properties. I'm going to go see one of their properties in Fort Worth when I'm down there for Super Doug. And, that should be pretty interesting. What is Super Doug, you ask? So Super Doug is this. This is where I'll be. I will be in Fort Worth Convention Center. It's kind of nice that the ad is right there for me. I didn't know it was there. I will be reporting for Seeking Alpha and just my own research and to meet with some people that I haven't seen in, since 2017 is the last time that I saw a lot of these people. So I'll go shake some hands and people ask me where I've been and I'll just say COVID. So I'm going to go really do some exploration. I want to find one or two more really good M&A targets in this space. So I will be down here and I'll be checking out one of the park hotels as well. So doubling up on the research. I really can't overstate how much I love park hotels right here. Vici. Now, here's the problem with Vici is they've really taken on a lot of debt to buy up all that property. And whenever I see concentration as big as Vici has on the Las Vegas Strip, I worry a little bit about what if something bad happens on the Las Vegas Strip? A shooting, a bombing. I think, that it's always a target. And I worry about the debt profile of this company. Not that I think the company can go under, but I just worry that they have a hard time increasing the dividends a lot going forward. So when we take a look at Vici and we see that the dividend yield is starting to creep down, I'm not so sure that I love Vici anymore. I think that it's still there. I think I have it on the list because I know a lot of you own it. If you own it, you may want to start thinking about writing covered calls against it. The dividend growth, is starting to come down. It was much higher than that a year ago when the rolling period reset. So I don't know that we can see as great of a future on Vici as we've seen since it started. You got that big rebound after COVID, and it's just been kind of chopping around 30. I don't know that there is a big ramp up. I think they really have to deal with their debt issues. So honestly, I don't expect this stock to be on our list unless their other businesses really start to do well. And I think if you get a rally here, you want to sell into that rally towards the end of the year, either in the new year or towards the end of this year, depending on how your tax situation is. I think the Vici around 40 can probably be replaced, upgrade your holdings. So, here's some confluence in here again, right around 40, start seeing different lines, the institutional pull, different fibs, different resistance levels. So if Vici approaches 40, I'd probably say get out of it. And if you want to buy, trade it when it gets back down to 30, buy it again, that's fine. But I think that this range is going to be pretty tight from middle 20s to 40, probably for a long time. Global Medical REIT, I think, is just being mispriced by the market right now. I think that they have a lot of upside as they pay down debt, and they're way more diversified than Vici. As they pay down debt, this is a stock that I think you can do very well on. Pays a good dividend, right? About a 9% dividend. Look at that. I mean, this is the sort of thing, this is the type of pullback that you want to buy. It's got pretty good support in the 8s. It's almost there now. And I think that the long-term trend for this, go ahead and read up on this company and the facilities that they have. Not only can it rebound to here, right? So look at that transaction, but I think that you're going to see it start to get back up to new all-time highs. Does it break out from there, or is it one of the ones that bounces off? We'll know in the future. But I think that it's a pretty good buy right here. You collect a big fat dividend. So if you are a dividend investor, right, this doesn't have the potential triple upside that I look for with growth stocks. But if you are a dividend investor and you don't want a lot of downside, but you want some upside, you want to collect a big fat dividend, global, medical REITs can be in that basket of REITs that you own. And that's really a way to look at Park and Vici and EPR and Broadstone and Global Medical. And even these are kind of REITs too, kind of a weird hybrid utility and REIT when you take a look at the clean energy ones. But, having real estate as backing to your investment portfolio, that's why people buy houses, right? They buy second houses, they buy investment properties. That's what these are good for. And I like this basket. And then you throw in American Tower from up here and Stag Industrial and Essential Properties Realty Trust. Now all of a sudden you've got 6, 7, 8 REITs that you can own, nicely diversified, heavy in experiences, heavy in essentials, heavy in industrial, with some medical additions, the cell phone towers. I mean, think about the way that I've built this, and I'll write an article just about managing REITs. The way that I've built this is you really get good industry diversification. So I really like this particular basket. I know that everybody's tempted, oh, I'll buy this one, but I'm not going to buy that one. Buy the basket. I think you should buy the basket and then you weight things. So like I think Park Hotels and Stag and American Tower, probably the ones that you weight the heaviest, right? Those might be, half positions, and then you get starters in the other 5. All right, utilities. Utilities are often a place for you to get income. Why do I like We Energies? And that's what we call it here. It's because they own such a big hunk of American transmission. And the build out of the grid is not only essential, it's backlogged by, they have back orders going 3 to 5 years out. So it's not like that business is going to disappear. American Tower, I have a friend in their ESOP, man, they're making all kinds of money. When American Tower finally gets spun out or bought out or whatever is going to happen, he's going to be a multimillionaire. And so I'm angling into that account right now. But the build out of the grid here, along with the fact that it's just a great company, I think is something that you have to be aware of. They pay a nice dividend. They just keep growing it. So this is on the very low end of what I would consider high yield, but their growth rate on the dividend for a utility is pretty darn good. And it's, again, it was a little bit less in the last year. So on this rolling 5-year period, it says 7.15, but it was recently about 8.5. So I would expect that to ramp up a little bit at some point as their CapEx spending goes down, which probably happens 4, 5, 6 years from now. This stock just, if you take a look at the chart, just grows and grows and grows, and it's been chopping lately. This is a really good spot. Look at that correction. Holds that line. I mean, that is just a really good line. So take a look at We Energies. And I think they go in a basket with Brookfield Renewable and Clearway, who are the leaders in renewable energy. Clearway just did a 110 million solar panel project in Texas that just went online. Obviously, Brookfield Renewable is Brookfield Corp. So this is the tracking stock. And I think that they're both basically buys right now. They're both on corrections. So you can see I've been trying to make this a lot more usable for actionable trades to make now, right? Not just to look forward, but, are we in a spot where you should be buying this? Yeah, I think between 24 and 20, I mean, you're right where you need to be for buying this over the next couple of months. If we get that little downturn in the market, these are all things that you can jump into. If you want to sell puts on them now, go ahead. I think the market angst might have started, but we'll see. Now, sure, go ahead and buy AT&T if you want, if it gets down to 15 again. I just keep seeing people thinking it's going back to the middle 20s. Maybe it will. I thought this for the longest time, but I just keep wearing out on their CapEx. So I don't think there's a ton of upside on AT&T. Maybe it gets to the middle 20s. I think 20-ish is more likely. But if you buy it at 15 and you're collecting that whopper of a dividend, right? 6.5%, and they're not growing it anymore. Remember that they're not growing it anymore. They've made the decision that when they finally have money to grow it again, right? They're not growing the dividend anymore. That was a one-off. That was when they did the spinoff. But they've said they're not going to grow it anymore. They're going to raise it like a penny a year. They're going to buy back shares though at some point. I think that happens middle to end of the decade. I think they're behind schedule on it. And again, it's just all the CapEx. But if AST Space Mobile gives them a new revenue source, that's all found money. And I think that is the upside, right? I think AST Space Mobile, this is what the traders are anticipating. This is the upside from AST Space Mobile, I think. If AST Space Mobile wouldn't materialize, then I think that you're here. Or if the CapEx is just as onerous as I worry about, then I think you're in here. So 20-ish to middle 20s, I think is the range that we expect AT&T to get to. But if they buy shares back, this is really a stock that I think for people who already own it, I just want you to know the story. I don't think there's anything better than this with AT&T. Verizon, did I close my window? If you wanted to pair Verizon with it, you could buy that on a pullback as well, down to about here. The Elliott waves are saying it goes in here. There's some confluence right there, that line, and the institutional draw. So 35-ish if you want to buy Verizon. And then my personal opinion, if it gets into the upper to middle 40s again, 45, 46, you start to lose a lot of the institutional draw once it gets pushing 50. So again, you could really trade both of these stocks in these narrow ranges if you wanted to. You'd have to make a living at it. But the nice thing about these is they're not going anywhere, right? They really don't have bankruptcy risk. They don't have, lose a ton of value anymore risk because they've already had it happen to them. Again, I don't love either one of these companies, but I know a lot of you own them. And if you just want something super stable with a big dividend check at the right price, you can do that with these. Nutrien. We had quite the gains in Nutrien, right? So we were buying, I actually had owned Nutrien way back there when I was in the 20s as Potash Corp. And then we bought it again. And we sold Nutrien like right at the top. And now look, it's come all the way back for us. So here, over 2 years later, we're getting a chance to buy Nutrien again. And I think that Nutrien, they're starting to buy back shares, pay down debt. They're really controlling their capex. And with Ukraine not likely to come online anytime soon with their potash again, they have some, but it's very at-risk supply and lower supply than it used to be. You take a look at Nutrien and you're like, man, they're okay here. They're jitterbugging. They had a little jump up. Now they're pulling back. Looks like that 50-ish price. It's about as good as it gets. Pays a good dividend yield. Again, at the very bottom of our high yield range. Not really growing the dividend a lot, just a little bit. So what you're looking for here, again, is the buyback story. So as they buy back shares, that fortifies the company. So the reason to buy Nutrien is, one, huge demand for their products, very limited new supply coming online, if any, and you really have a well-managed company. They're handling their balance sheet really well. So I think you can see Nutrien probably not go all the way back up to 100 plus, but I think this area in here makes a lot of sense. That's where the institutional draw is, and these lines here have to do with the Elliott waves. This price in the 80s makes a lot of sense for Nutrien. So if you can collect the 4% plus dividend, the buybacks and the well-managed company and the demand for the product, the limited supply, all those things pull it back up into the 80s, that's a pretty good trade for you, right? That's a good position trade. That's something that you can own. So as you get into it here, just understand that your exit probably starts in the 80s unless there's a FOMO rally going. If there's a FOMO rally, then you hold on a little bit longer. And then Kohls. So this rightly should be on the turnaround list. And when I put out the turnaround list, it will be on the turnaround list. Kohls has such good real estate. I mean, really spectacular real estate. And that's why the private equity companies keep coming after them and trying to buy them out. The management in Milwaukee is not going to sell the company. They'd have to get a really good price. They'd have to get a price pushing 60, and nobody's offered that. So they're going to try to figure out how to do this on their own. They were going to expand into all the little boutique stores, and they replaced that CEO and said, look, you just got to get out of here because you're not doing things right. So they fired the CEO. They called it a resignation, but they fired her. And it was for all the same reasons that I gave a couple of years ago. So the new CEO, I don't know that he's the right guy, but I think that he has an understanding of how to manage the CapEx. Kohls already has the big relationship with Amazon. I don't think Amazon buys them out, but I think Amazon expands. I don't know what an Amazon store would look like. Maybe they set up part of the store with demonstration products and kiosks. I'm not positive, but there's a way for them to maximize the Amazon relationship the same way they're doing with Sephora that they haven't done yet. There's a way for them to maximize all the real estate footprint they have. I mean, they have all kinds of parking lots that are half empty. So put our building in those parking lots, maybe add a lot more residential. So we'll see, or medical. They've been adding medical clinics next door to, in fact, one of the clinics I go to is next door to a Kohls. So they have a lot of upside. It's going to rely on execution. The management has typically gotten there with this company. They've gone through a rough patch. And I think that the recent change in management, I think the willingness to at least listen to what the private equity is saying and, cannibalize the idea and take it for their own, I think is there. I can't say I know these things firsthand, but the grapevine that I'm part of seems to indicate this. So I think that Kohls is a stock that you can probably buy if you're patient, if you're not going to get shaken out. It pays a good dividend. I think it already bottomed. I think little pullbacks are all you need to buy it. 25-ish, and it should double. It really should double at some point. This is really, private equity firms aren't trying to get this because they don't think it's worth something. It's worth something, and I think everything's aiming right in here. And I think that this is the low target. About 45 is the low target, and I think that it can blast through there if they have a good real estate strategy. Which, how can they screw that up, right? So, I say that tongue in cheek because management screw up all the time. But I think that they can probably get there. Yeah, a little bit of this would be the breakout range, towards new highs. Could it go higher? It could. Again, really depends on what they do with the real estate. They could spin the real estate off into a REIT, and maybe there's some M&A with that. We'll see. But I think a price in the 40s is, to me, very likely. All right. What kind of questions do you have about the punch card dividend stocks? All right. So the Park Hotels was a special dividend. Today we're talking about dividend stocks. I took Coca-Cola and Pepsi off. They were moved over to the grandpa stocks. I took the banks off just because I'm never going to invest in banks. Unless I can get these companies off of just a deep dive, I'm not going to buy them. I can always find something better than banks. And yeah. I don't think NEE. Next era we could add, but they're not I'm trying to find companies that we can buy in the next couple of months. And I just think Clearway and Brookfield are better. Could you add them as part of that basket? You certainly could. I mean, I like the company, but you run out of places to go. It didn't quite fit in with the high yield theme. Dividends not growing super fast. It's pretty fast. So if I was going to add this somewhere, I guess it would have to be on the dividend growth list. And it could end up there, but dividend growth, that's just barely makes my hurdle. I can do better, right? We're only investing in 20 to 30 stocks. So are there a lot of good companies? Sure. But how do you maximize your return? It's all relative, right? You're managing risk, you're managing return potential, and some of you want income. So you need to find a way to have that built-in margin of safety. And I think that what I've done here is probably better than what it was. Kind of made it a smaller list. If you want to do the baskets, do the baskets. I think there are some must owns. I think Pfizer is a must own. I think Ford is a must own. I think Newmont, if you have even a little bit of gold bug in you, then go ahead and buy it. Innovative, if you don't mind that it's cannabis, I think that they have the potential to rally most of the way back to all-time highs. Maybe get 60-70% of the way back. Comcast, I think, is ultimately a big winner in what's going on. That they've been the best managed. American Tower, I think they're a must own if you can get them at the right price. Stag Industrial in the industrial REIT space. You could own like 3 industrial REITs. Stag is my favorite. Again, I favor the companies with more growth potential. Essential Properties Trust really has grown on me. So I like these 8 companies, and then Ford and Pfizer, and maybe Kinder Morgan again, and then Park Hotels. So those 12 are probably the ones that I'm going to own. And then the rest of them are here for you to build out some diversification. In certain accounts, I'll own these 3 as well, right? The utilities. Because Clearway and Brookfield Renewable Corp are really the new type of utility along with NextEra. And if you take a look at what's going on in the clean energy space, it is clear that it's one of the fastest growing spots in the world. So, when Clearway puts about 1.1 million solar panels over 6 square miles in Texas to provide the energy for 200,000 to 300,000 homes, wake up. It's happening. So when the clean energy bears are like, oh, clean energy is still only 6% of the grid. Okay, so if you're only counting wind and solar, that's true. However, it's also growing at 30% per year. And almost all of the new additions are solar, not wind. So solar is going to completely get rid of coal and regulate coal to being an emergency power source. I actually don't think they tear down most of the coal-fired power plants. I think what they do is they just put them in the maintenance mode, and they have a big pile of coal for if there's ever an emergency. I think they become emergency power stations, and I think it's coming fast. If you take a look what's going on in China and India and even here, and the fact that Texas is this oil guzzling, oil and gas state that's leading the country. I think it's second in solar deployments. It should become pretty clear if the oil guys are in there, then there you go. For large biotech, Pfizer or Bristol Myers. Well, I've told you to buy them both. So I think that you can I own them both. I own both Pfizer and Bristol Myers. Again, in retirement accounts that want dividends. For accounts that want a little bit more stability and they're willing to trade some upside and they want some income, that's how you do it. You pare back your growth stocks to 10 to 20% of the portfolio, and you add your Pfizers and your Bristol Myers and things like that. So this is a way for the retirees to build a basket that has more growth than almost anybody else's dividend portfolio. You see some of the dividend portfolios with the other services, or you just see some of the articles, and they're taking growth stock risk without growth stock upside, and they're chasing yields for companies that may not be able to sustain those yields. So these are all companies where I really don't worry about the dividend, and I think that there's a lot more upside with these companies. Nutrien, Kohls. I mean, it's real estate. Nobody's valuing their real estate except private equity. So the stock market doesn't value the real estate, but the private equity firms do, which is why they keep trying to buy it. Nutrien, they're the horse. I mean, they're the 800-pound gorilla in fertilizer. So unless you think that the Ukraine situation is going to resolve itself in the next couple of years, they're a big deal, and they're just so beaten down. I mean, they're beaten down as if Ukraine wasn't going on. These are fast-growing utilities. These are fast-growing utilities as far as utilities go. So Park Hotels I just think that the hotels bottomed out a couple of years ago, and I think that they have a very, very long run of upside. And the best run hotel companies, and I think Park Hotels is one of them, and it's all luxury. I think that this is one of the places to go. I think that they can possibly do a merger with somebody. We'll see. I'm trying to remember the name of the other luxury hotel chain that it's the Hilton spinoff. So anyway, Les says that Texas generates 2 times more power than any other state. So you mean solar power? Yeah, they might. I know that Nevada, basically the Las Vegas Strip is powered by solar. So that's a lot of lights. But yeah. We'll talk about the growth stocks next week after the list is out. So I'm going to do a similar list for the growth stocks. There you go. Punch card growth stocks. So again, I'll have this out next week. There are going to be some stocks that aren't on it. I decided after looking at this to do the turnaround value list, which I'll put out the week after that. The turnaround value list will have Kohls and Warner and Paramount, right? Because there's risk in turnarounds. Why? Because they don't always turn. So we're going to break these out, and that way you can pick from the part of the smorgasbord that you want to eat at, and we'll see. I want to be in companies that I believe have a lot of upside based on the business. I don't want to just guess whether or not the stock price will go up. I want to know that the business is going to do really well. And companies like Lumen have proven over and over again that it's just a super slow ship to turn. They should get bought out. I don't know what the regulatory issues would be with that, but Lumen just shouldn't be their own company. Google, I still think buys them if they decide to go that route. Otherwise, at this point, why wouldn't AT&T just reabsorb them? So, again, it comes down to regulatory concerns. I think is the federal government smart enough to realize that these companies just might not exist if they're not allowed to merge? Lumen for sure won't be on any list. I don't even think they'll be on the turnaround value list. You'd have to convince me to spend that kind of time on it again. So I haven't looked at some of these companies in years that you're bringing up, and it's just because they haven't shown the execution to warrant the attention, right? They're not a good enough story. We have all these good stocks that go up because the management is doing a good job and they protect the businesses, and the businesses have some sort of moat. That's what you're looking for. You're looking for a business that isn't getting cannibalized by other players in the market, right? You don't want to be in a business that's losing market share. So pretty simple. In any case, S&P 500 growth stocks, there's a few gorillas that we can invest in. Some of them are already on the grandpa stocks, the mid caps that are racing towards inclusion in the S&P 500, always a place to invest. Small companies, if you can find them, and companies about to be added to the Russell 2000. That's just like the trade when companies jump from the mid cap to the S&P 500, except that because it's a law of small numbers, the percentage increase is usually way bigger on a micro cap becoming a small cap. Somebody asked about Newmont. Yeah, I am a-okay with Newmont, everything that they're doing. So I know that people want to whine about nickels and dimes, but gold is still gold. And until you convince me that people are going to stop wanting gold, a handful of miners are going to do very well. Now, the biggest money in gold miners is find a junior company that you can figure out whether or not they're actually going to succeed. The junior miners, if you can find them, can be, huge stocks. But, I think that gold is showing that it's getting ready to break out. I think it's going to head out to $3,000 an ounce at some point. We know that because it's getting harder to mine, demand isn't going anywhere but up. Yeah, I think that Newmont is the play there. We're getting a price right now, and whether it gets all-time highs or not, I don't know. But I think doing a retrace of halfway back up to the highs, give or take, one of those 61.8% Fibonacci moves, I think is highly likely. All right, I'm going to call it a day. I'm going to edit the Saturday video, and then this one should be ready to be edited. So I'll get these both edited this afternoon and up, and then I have some appointments to take and hair to get cut. All right, have a good one.